Hello guys and welcome to my YouTube channel. This is the first video on my channel, so I thought it would be a good idea to make it an introductory video that basically explains the purpose of this channel and the kind of content you should expect going forward on this channel. Now, in my years of analysis in the financial market, I've come to realize that the most important yet basic component of technical analysis is market bias. I'm sure you've heard about market bias before. One of the things I've come to realize is we underestimate our tendency to forget the basic things as we advance in any endeavor, right? So if you're learning how to do technical analysis, the very first thing you learn is to figure out what direction the market is most likely to go: up, down, sideways. Those are the only three directions the market can go. But then when you go advanced, it's very easy to get carried away and get so focused on how do I enter the market? How do I execute? Where do I enter? What candle do I enter? What indicator do I use? What supply zone? What demand zone? What order block? All of that is not as important as you think. The most important thing is your bias. So, what is market bias, right? Market bias is your objective opinion on the direction of the market. This is very, very important because there are only two operations you can carry out. You can either buy or sell. So, if you know whether the market is going up or down, you have like 80% of your problem solved, right? Now, your execution strategy, no matter what it is, will work. Now, the caveat being the execution strategy must actually have a proven track record that shows that it has an edge in the market. It might sound controversial. You might say, if I have an execution strategy that has an edge, then why do I need to focus on bias? Why can't I just look at my checklist on my execution strategy and just execute? Now, if you agree with me, if you've had a couple months, years in the market, you realize that no matter the execution strategy you have, at any given point in time, there's a very high probability that it would give you signals to buy and sell. This is one of the major problems that most new traders encounter. You go into the market without a bias and you see a setup to buy, but at the same time, you see a setup to sell. And then you get confused and you don't even know what to do, and then most times you end up taking the right one, but then you get scared when there's some resistance, and then you switch your bias, and then you're just all over the place. This is the importance of market bias. So the purpose of this channel going forward, I want it to be sort of a training wheel to new traders to help you have a market bias on a weekly basis. Now I'm going to be starting out with the currency market, majorly the US dollar, because of course we know the US dollar is king in the currency market. The US dollar is a component of 85% of all currency transactions. We all know that. I am focusing majorly on the US dollar in line with the major currencies because whatever the dollar does, all the major currencies follow. So that's where I'm going to be starting out on this channel. Now, the rest of this video is going to be a brief discussion on the components of my analysis that I use to derive my market bias. So going forward, the videos are going to be a little easier to digest because you would have seen this video that would explain to you these major key points in my analysis to figure out my market bias. Now, going into this, I have two categories. I have my quantitative analysis and I have my qualitative analysis. Starting out with my quantitative analysis, there are two components: seasonality and interest rate differential. Seasonality is a predictable change that repeats in the market every year at the same period of time. This is caused by economical, geopolitical, and climatic factors like seasons, political events such as elections, holidays, and so much more. To explain this better, I'll just take you to a seasonality chart. This is a seasonality chart of the DXY collected over 56 years, as we can see here. What does this tell us? This tells us that over the span of 56 years, January has the highest probability of closing bullish. How was this derived? Checking through 56 years, you realize that most of the time January closes higher than it opens. April, June, July, September, December close lower than they open. Now, this doesn't mean that you cannot have a bearish January. This doesn't mean you can't have a bullish July. It just means the probability is higher. And like we all know, technical analysis is all about probabilities. You need to tip the probabilities in your favor to have an edge in the market, right? So if you are taking a bullish stance on the dollar in January, you already have a very high chance that you will be right. But if you pair this with other things I'm going to talk about, you solidify your bias and focus on those high probability, high quality trades. Another important thing I want to mention about seasonality is the fact that January is bullish doesn't mean January is going to change the trend or turn the whole market around. Now, January being bullish can just be a retracement to continue bearish into February, March, and April, like the seasonality suggests. So, there's still a bit of skill to understand seasonality and interpret it correctly. But I put it under my quantitative analysis because it is pretty objective. It is what it is. It is data that has been collected and crunched over a period of time, and it is just what it is. So, what are interest rate differentials? Interest rate differential is the difference between the interest rates in two different countries or currencies. Investors seek higher rates. This is why interest rate differentials is even a thing. Everyone wants higher interest rates. If I present to you two opportunities, one having an interest rate of say 3% and one having an interest rate of 8%, you will obviously go for the one with the interest rate of 8%. This is universal. This applies to everybody. It applies to banks, investors, hedge funds, common people. Everyone wants higher interest rates. So a currency with higher interest rates will fundamentally translate to currency strength. If you're looking at the US dollar, the Japanese yen right now, the US dollar has the highest interest rate along with the New Zealand dollar, while the Japanese yen has the lowest interest rate. If you go to your USD JPY chart, that's an assignment for you. Look at the trend for the longest time. It has been massively bullish. Barely any retracement. It has just been screaming for higher prices. That is what happens when there's an interest rate differential between two currencies. Let me show you an interest rate differential chart to explain this better. Now, this is an interest rate differential chart between the interest rates on the dollar, the US dollar, and the interest rate on the Canadian dollar, which is the red line, and the US dollar interest rate is the teal line. When the US dollar is lower in interest rates than the Canadian dollar, the USD card tends to dump, and the reverse happens when the US dollar's interest rate is higher than the Canadian dollar interest rate. Now, one important thing to note about interest rate differentials is the interest rate of a currency going higher than another currency doesn't translate to instant trend change or whatever. You still have to look at this in line with actual market structure. So an interest rate might change relative to another currency, but you need to see market structure confirm an interest rate differential before it becomes important. Let me say that again. When market structure confirms an interest rate differential, it becomes important. So this is the second component of my quantitative analysis. This is the second thing I look at in my quantitative analysis to determine my bias. Now, my qualitative analysis, it has two components as well, intermarket analysis and top-down analysis. Just so you know, this section of my analysis is subjective. That's why I termed it qualitative analysis, because it is reliant on how well you can interpret price action and determine what the market is doing at any point in time. Now, with that out of the way, intermarket analysis is the analysis of two or more correlated assets to determine the relative strength or weakness of an asset. Now, there are two ways I approach intermarket analysis, one of which is comparing assets in the same asset class, for example, the currency market, or comparing assets from two different asset classes, an example being the bond market and the currency market. Looking at these charts here, we have the Euro USD and GBP USD charts. These two assets are positively correlated, which means they tend to move in the same direction. Now, if you look over here, you see that whenever the Euro USD is in a bullish trend, GBP USD is also in a bullish trend. Whenever Euro USD is in a bearish trend, GBP USD follows suit in a bearish trend. Now, how does this help you in your analysis? It's very obvious. Because they are positively correlated, if you're taking a bullish stance on Euro USD, you should likewise be taking a bullish stance on GBP USD. It makes no sense to be bullish on Euro USD and bearish on GBP USD. The probabilities will not be in your favor. Now, one of the most important things I use in intermarket analysis, the cornerstone of my intermarket analysis, is divergence. Between two correlated assets, as we have here, whenever a higher high is made on the Euro USD, we expect a higher high to be made on the GBP USD. Whenever we have a crack in correlation between these two assets, it shows underlying accumulation or distribution depending on what is happening, depending on if the highs and the lows are in disagreement or not. This just shows that investors are stepping in. Investors are aggressively buying or selling one asset as opposed to the other, which gives you a hint. It's a telltale sign that shows you what the big players are actually doing in the market. If you look at this chart again with these markings, it makes you realize that between March to October in 2023, there was a divergence between the Euro USD and GBP USD. GBP USD made higher low while Euro USD made a lower low. It took out a low while GBP USD failed to take out that low. And as a result, we've seen higher prices towards the end of 2023 into 2024. Now, this is, like I said, very, very important because this shows you that there's a short term or long term potential change in the order flow coming very, very soon when you see a divergence like this. Now, looking at this is the other aspect of intermarket analysis that I use. This is the US dollar index, which is from the currency market, and this is the US dollar 10-year bond yield, which is from the bond market. Now, you might be wondering, how is the currency market connected or correlated to the bond market? Generally, as I explained earlier, when interest rates are high, investors get interested. So, well, the same reason I gave you for interest rates differentials driving price, making currencies more valuable or less valuable, applies to bonds as well, because bonds have yields. Yields basically means interest rates. So whenever the interest rate of bonds, the US bonds in this example, is high, what does that do? It attracts investors. Yield is yield. Investors seek yield. So when the yields are high, investors will flock to buy the US bond, which would in turn get them to buy the dollar, which would just create demand for the dollar and make the dollar more valuable, right? So technically, US bond yields up means dollar up. So if you have that in mind, you analyze the bond chart, you realize that the bond yields are on a bullish trend, the bond yields are going higher. That just means that you should be buying the dollar. Taking a look here, we see that whenever the dollar is on a downtrend, the bond yields are kind of on a downtrend, even though here was a bit flat, but same thing. Over here, when the dollar is on the bullish trend, we see that that is also the case with the bond yield, right? Taking a closer look, you realize that this same divergence thing applies here as well, because whenever there's correlation between assets, a crack in that correlation tips the hands of the big players to show you that something is off. An interesting move is about to happen. A move I can participate in is about to happen. Now you look over here, you realize that around April 2023, all the way to about August, the dollar index made a lower low. However, the bond yields kept going higher. This shows that there's a divergence, big players are involved, and as a result of that, we've had higher prices going all the way into 2024. Now to the second component of my qualitative analysis, we have top-down analysis. What's top-down analysis? Top-down analysis involves market analysis that begins by looking at the higher time frames, that's a bigger picture, before dropping down to lower time frames. Now let's get right to it and see what my top-down analysis entails. Now my top-down analysis is very simple. Very simple and structured. It's price action based. There are four major components: supply and demand, market structure, gaps, and candlestick open, high, low, close analysis, right? So I don't want to make this video too lengthy, so I will not really delve deep into each of these components. I will just briefly talk about them, and as we go on, get to see how I apply these components to my top-down analysis. Supply and demand, I majorly use order blocks as my supply and demand levels. If you don't know what order blocks are, going forward, you would see and learn about order blocks as I analyze the charts with you. Market structure, I look at ranges, internal and external ranges. This is based on the fractality of price, because price action is fractal, so I tend to trade from one range to another. A range inside a bigger range I refer to as an internal range, and that bigger range is my external range. Now I trade majorly the foreign exchange markets, and if you have some experience in the foreign exchange markets, you know that over 70% of the time the price is in a range. Now the size of the range differs, but it is usually in a range. I also look at gaps between candlesticks for efficient delivery of price. Now candlestick analysis, I look at divergences as we discussed earlier. I look at swing highs and lows which I would explain more going forward, and engulfing candles, which you should know as part of my candlestick analysis. And that's basically it. That is a very brief and short explanation of my top-down analysis. Now, I know this is not very detailed, but I did not want to make this video too long, and I believe going forward, as I analyze the market with you, you would get to see how I implement these 4 pillars of my price action analysis. Now, thank you so much for watching to this point of the video. If you've watched to this point of the video, please leave a thumbs up, say something nice in the comment section. Pardon me, this is my first voiceover, this is my first video, first content I've ever created, so I might be rough around the edges, but bear with me, I'll get better as time goes on and as you give me feedback. Subscribe, of course, share this with anyone who would be interested in this kind of content, and until next time, see you in the next video.